some interesting things from this survey is that your investors are looking to add a lot more risk. But, are there any concerns about that at this part of the cycle as well?
Well, Sonali, there's always concerns, and great to speak to all of you. I think first leading off, I think the key takeaway from the survey is risk on. We see it broadly. We see it across the industries, the life industry, the property casualty industry, the reinsurance industry, the healthcares. We see it across regions, in Europe, in Asia, in the Americas, in Bermuda. And we see it across the risk spectrum, equities, fixed income, credit, and illiquidity. But yeah, there are concerns. And I think one of the bigger concerns is inflation, quite frankly. In prior years, survey respondents said that they were concerned about deflation, particularly out of Europe. And now that's completely reversed, and the concern is about inflation. Part of that is leading to the demand for equity-oriented securities, such as private equity, public equity, but also floating rate fixed income instruments.
Michael, anyone asking you about crypto? I mean, we've heard the pension funds looking at it. We've heard of long-term investors. Anyone wanting to go even down that sort of level of risk food chain?
So, we get questions about crypto, but not necessarily because it's viewed as an investment for the balance sheet, but more what is the implications of the movement in crypto? Is there something to be read about that in terms of inflation expectations? But crypto, generally speaking, the view would be it's a commodity, and insurers don't generally hold a lot of commodities on the balance sheet. They don't own gold or silver, as an investment. So they wouldn't look at crypto as an investment, more a signal for what's taking place in the markets.
So I'm curious to hear about just the volatility and some of the expectations for volatility here, because when I look at the types of clients that are part of this survey here, I tend to look at them as being folks who maybe are a little bit, more risk averse in the sense, not just of taking risks, but making sure that they're actually in an environment where they can sort of be a little bit more sanguine about the predictability here. What are their general thoughts here about volatility going forward?
It's a very conservative investment base. They have liabilities that they have to be able to meet. But it's several things. One, the industry coming out of the pandemic on a financial basis is in very strong footing. That's not to say that the companies themselves, their employees and their clients haven't had issues, healthcare issues and other issues. And that's not to say that they haven't experienced higher claims, workers' comp, business interruption, healthcare claims and mortality claims. But the industry is very well capitalized and very liquid. And when they look out for the next 3 years, notwithstanding Sonali's question about concerns, they see a growing economy, tremendous amount of fiscal stimulus globally, tremendous amount of monetary easing globally, and slowly, the pandemic hopefully coming under control and being something in the past. So when they look out, they don't see a recession for the next 3 years. They see corporate credit being in pretty good shape. Granted, spreads are tight and equity valuations are high, but they don't see a recession coming for a while.
Well,
and as a result, it's a good investing opportunity.
Let's talk about credit debt for a second, because, one of the places they are most negative, looking to sell, is a place where they traditionally were big buyers, and that's government and agency debt. How could this become a problem moving forward, especially for that market?
Well, it's not a significant part of the balance sheet. And quite frankly, the yields at this point are too low for them to carry on their balance sheet. In the U.S. market, we've got the 10-year, call it 160. You've got bonds at negative interest rates. You've got JGBs at zero interest rates. They can't afford to hold that kind of asset on the balance sheet, earning virtually nothing. But going into things like investment grade corporates are a similar substitute, but you pick up the corporate spread there. And again, if you got a good view towards the credit cycle, that we're going to be in an improving credit cycle for a while, it's not a bad place to be. But Sonali, I wouldn't be concerned about significant selling of government securities into the market and depressing yields. But the flip side of that is I don't see any demand coming out of the industry for government securities.
And very briefly, I mean, we head towards World Day, of course, thinking about the environment, ESG where it's at as well?
Well, that's one of the biggest changes that we've seen year over year in ESG. For the last decade, we've had positive readings out of Europe, more recently out of Asia, and now finally out of the States. ESG has become a very, very important factor for these companies. And it starts at the CEO level, it's at the board level. If you take a look at the annual reports, you'll see it mentioned by almost all of the public insurers. And then it translates down into the operations. What should we be insuring? Who should we be insuring? And it translates down into the investments. What should we be owning? And it's not only defensive, protecting against environmental, social, and governance factors, but it also could be very proactive, putting capital to work that may have an added benefit in one of those three factors, environment, social, or governance. We absolutely see that as an increasing interest by our insurance clients globally.